What if I told you that the 1929 crash wasn't a sudden catastrophe, but the inevitable endpoint of a seven-stage cycle that had been unfolding for an entire decade? A cycle so predictable that economists at the time saw it coming, warned about it, and were completely ignored? And what if that same seven-stage pattern is not only repeating today, but we already deep into stage 5? This is not speculation. This is pattern recognition. And the pattern has never been wrong. Between 1920 and 1929, the American economy didn't just grow. It underwent a systematic transformation that created the conditions for the greatest wealth destruction event in modern history. But it didn't happen randomly. It followed 7 distinct stages, each building on the last, each making the final collapse not just probable, but mathematically certain. Stage 1, the post-crisis euphoria. Coming out of World War I and the recession of 1920 to 21, America experienced what felt like a miraculous recovery. Industrial production surged. New technologies, radio, automobiles, electrical appliances, created entire industries overnight. The Dow Jones went from 63 points in August 1921 to 381 by September 1929, a six-fold increase in 8 years. Stage 2, the credit expansion. With prosperity came easy money. Margin buying, purchasing stocks with borrowed funds, became normalized. By 1929, margin debt had reached $8.5 billion, nearly 10% of GDP. You could buy $100 worth of stock with just $10 of your own money. The Federal Reserve, instead of restraining this, actively encouraged credit expansion through low interest rates. Stage 3, the wealth concentration. By 1929, the top 0.1% of Americans held 25% of all wealth. The bottom 80% held just 15%. Corporate profits soared while real wages stagnated. The productivity gains from new technology flowed almost entirely to capital owners, not labor. This created a fundamental imbalance, a consumer economy where consumers had decreasing purchasing power. Stage 4, the speculative mania. By 1928, the stock market had detached completely from economic fundamentals. Price-to-earnings ratios reached levels never seen before. Investment trusts, the 1920s equivalent of today's ETFs, proliferated, often buying shares of other investment trusts in circular ownership structures. Everyone from shoeshine boys to bank presidents was playing the market. The economist Roger Babson warned in September 1929, "Sooner or later a crash is coming, and it may be terrific." Stage 5, the insider exit. In March 1929, 6 months before Black Thursday, something changed. Insiders began quietly liquidating positions. Joseph Kennedy, patriarch of the Kennedy dynasty, famously exited the market after receiving stock tips from a shoeshine boy. The smart money didn't announce their departure. They simply stopped buying and started selling, slowly, methodically, while public participation was still accelerating. Stage 6, the crack and the rally. October 24th, 1929, Black Thursday. The market dropped 11% in a single day. But here's what most people forget. It recovered. Leading bankers, including J.P. Morgan Jr., publicly bought stocks to stabilize the market. For 2 days, it worked. The public was told the worst was over. President Hoover declared the economy was fundamentally sound. Stage 7, the collapse. October 28th to 29th, 1929, Black Monday and Tuesday. The market lost 23% in 2 days. But that was just the beginning. By July 1932, the Dow had fallen 89% from its peak. $30 billion in market value, equivalent to $500 billion today, simply evaporated. 9,000 banks failed. Unemployment reached 25%. The crash wasn't the disease. It was the symptom of an economy that had been fundamentally hollowed out during the preceding stages. This is the pattern. 7 stages. Boom, credit, concentration, mania, exit, false recovery, collapse. And it has repeated, with variations, in every major financial crisis since 1987, 2000, 2008. And it is repeating now. Let me show you, stage by stage, where we are today. Stage 1. The post-crisis euphoria, 2009 to 2015. Coming out of the 2008 financial crisis, we experienced what appeared to be a miraculous recovery. The S&P 500 bottomed at 666 in March 2009. By 2015, it had nearly tripled. Tech companies were valued in the hundreds of billions. The unemployment rate fell from 10% to 5%. The Federal Reserve deployed unprecedented quantitative easing, creating $4 trillion in new money to purchase government bonds and mortgage securities. The narrative was identical to 1921. We had survived the crisis, learned our lessons, and entered a new era of sustainable prosperity. The phrase, "this time is different," returned to the financial lexicon. Just as in the 1920s, new technologies, smartphones, social media, cloud computing, created the illusion that we had transcended the old rules of economics. But beneath the surface, something fundamental had changed. The recovery was not built on productivity growth or rising wages. It was built on debt and asset inflation. Stage 2. The credit expansion, 2015 to 2020. By 2020, total U.S. debt, government, corporate, and household combined, had reached $80 trillion, or 400% of GDP. For context, in 1929, total debt was approximately 300% of GDP. Corporate debt alone had ballooned to $10.5 trillion, much of it borrowed at near-zero interest rates not to invest in productive capacity, but to buy back stocks and pay dividends. Margin debt, the same mechanism that amplified the 1929 crash, reached $778 billion by early 2021, the highest level in history both in absolute terms and as a percentage of GDP. Retail investors, empowered by zero-commission trading apps, borrowed billions to speculate on stocks, options, and cryptocurrencies. The Federal Reserve, like its 1920s predecessor, encouraged this. Interest rates remained near zero from 2008 to 2015, and again from 2020 to 2022. The message was clear. Borrowing was not just safe, it was rational. Debt had been transformed from a risk into a strategy. Stage 3. The wealth concentration, 2015 to 2023. Between 2009 and 2021, the wealth of U.S. billionaires increased from $1.3 trillion to $5.1 trillion, a 292% increase. During the same period, the median American household saw wealth increase by just 17% in real terms. By 2023, the top 1% held 32.3% of all U.S. wealth, the highest concentration since 1929. Why? Because the post-2008 recovery was an asset price recovery, not an income recovery. If you owned stocks, real estate, and businesses, you became vastly wealthier. If you depended on wages, you stagnated. Real median household income in 2023, adjusted for inflation, was barely higher than in 1999, a quarter century of zero-wage growth. The parallels to 1929 are not metaphorical. They are structural. Just as in the 1920s, productivity gains from technology have flowed almost entirely to capital. The difference is scale. In 1929, the wealth gap affected millions. Today, it affects hundreds of millions globally. And just like in 1929, this creates a fundamental problem. A consumer-driven economy where consumers lack the purchasing power to sustain consumption without debt. Which brings us to Stage 4. Stage 4. The speculative mania, 2020 to 2021. In 2020 and 2021, something extraordinary happened. Locked in their homes during the pandemic, armed with stimulus checks and zero-commission trading apps, millions of Americans entered the market for the first time. Meme stocks like GameStop and AMC surged thousands of percent based not on earnings, but on coordinated buying campaigns organized on Reddit. SPACs, special purpose acquisition companies, essentially blank check investment vehicles, raised $162 billion in 2021 alone, often with no clear business plan. Cryptocurrencies, which had spent a decade on the periphery of finance, exploded. This was not investing. This was speculation detached from any underlying value. And it had an exact historical precedent. In 1929, investment trusts proliferated wildly. By September of that year, there were nearly 750 investment trusts with total assets exceeding $8 billion. Many of these trusts bought shares in other trusts, creating circular ownership structures with no real assets at the bottom, just layers of leverage. Does this sound familiar? It should. It's exactly what happened with SPACs and crypto in 2021. Financial instruments whose value derived entirely from the expectation that someone else would pay more for them later. Price-to-earnings ratios in 2021 reached levels not seen since 1929 and 1999. Tesla, a car company producing fewer than 1 million vehicles per year, briefly reached a valuation of $1.2 trillion, larger than the next 10 automakers combined. Companies with no profits, no clear path to profitability, and in some cases no product, commanded multi-billion-dollar valuations. The economist John Kenneth Galbraith, writing about 1929, observed, "The singular feature of the Great Crash was that the worst continued to worsen." We are about to see why. Stage 5. The Insider Exit, 2021 to 2023. This is where we are now. And this is where the pattern becomes undeniable. Between November 2021 and December 2022, corporate insiders, CEOs, CFOs, board members, sold $170 billion worth of stock in their own companies. This was the largest insider selling spree in recorded history, both in absolute terms and as a percentage of market capitalization. In November 2021, Jeff Bezos sold $10 billion in Amazon stock. Mark Zuckerberg sold $4.4 billion in Meta. Elon Musk sold $16.4 billion in Tesla between November 2021 and December 2022. These were not routine diversification sales. These were exits. Warren Buffett, whose Berkshire Hathaway had accumulated a cash position of $189 billion by mid-2024, made his position explicit: "We'd love to spend it, but we won't spend it unless we think we redoing something that has very little risk and can make us a lot of money." Translation: there are no good investments at current prices. But here's the critical detail that makes this stage 5, not stage 7. The public is still buying. Retail investment in 2023 and 2024 has remained elevated. Target date retirement funds continue auto-investing billions monthly. The narrative in the financial media is that this is a healthy correction, that every dip is a buying opportunity, that time in the market beats timing the market. This is identical to 1929. In March of that year, 6 months before the crash, insiders began exiting while the public continued buying. In the summer of 1929, as stock prices set new records, margin debt reached its peak, meaning small investors were borrowing more than ever to buy stocks that insiders were selling. The smart money doesn't announce when they leave. They simply stop buying and start selling. And they've been selling for 2 years. Stage 6. The crack and the rally, 2022 to 2024. Now we come to the most deceptive stage, the false recovery. In 2022, the S&P 500 fell 18%. The Nasdaq fell 33%. Over $10 trillion in market value disappeared. Treasury bonds suffered their worst year in history, losing 17%. For a brief moment, it seemed the reckoning had arrived. And then, in 2023, the market rallied. The S&P 500 gained 24%. The Nasdaq surged 43%. By early 2024, the S&P had reached new all-time highs. The media declared the bear market over. The Federal Reserve signaled it would begin cutting interest rates. Investors were told the worst had passed. This is the trap. In 1929, after Black Thursday on October 24th, the market initially recovered. J.P. Morgan and other leading bankers publicly bought stocks to stabilize the market. President Hoover declared the economy fundamentally sound. For 2 days, prices rebounded. Investors who had panicked on Thursday congratulated themselves for not selling at the bottom. And then came Black Monday and Tuesday, October 28th to 29th, when the market lost 23% in 48 hours. The rally after the crack is not evidence that the crisis is over. It is evidence that the crisis is entering its terminal phase. It is the moment when the remaining retail investors, seeing prices recover, commit their last capital, providing the liquidity for the final wave of insiders to exit. Look at what's happening now. In 2023 and 2024, stock buybacks have continued at record pace, over $800 billion annually. Companies are using borrowed money and cash reserves not to invest in growth, but to artificially inflate stock prices while insiders sell. The market is rising not because of economic strength, but because of financial engineering. This is stage 6. The crack has happened. The rally is underway. And what comes next is stage 7. Stage 7, the collapse. I need to be precise about what stage 7 means, because the term collapse carries emotional weight that can obscure the actual mechanism. The 1929 crash was not a single day. It was a process that took 3 years. The market didn't fall 89% in October 1929. It fell 89% between September 1929 and July 1932. The crash was the trigger. The collapse was the unwinding of all the leverage, all the debt, all the speculative excess that had accumulated during stages 1 through 5. Here's what actually happened in stage 7 of 1929 and what the pattern tells us will happen again. First, the liquidity crisis. When the market crashed in October 1929, margin calls went out across the country. Investors who had borrowed to buy stocks were required to either deposit more cash or have their positions liquidated. But there was no cash. The money had been borrowed. So stocks were sold into a falling market, driving prices lower, triggering more margin calls, forcing more sales. This is a liquidity death spiral, and it is self-reinforcing. Today, margin debt stands at $680 billion as of late 2024. For context, in 2008, margin debt peaked at $381 billion. When the selling begins, hundreds of billions in leveraged positions will be liquidated. And this time, it's not just margin debt. It's algorithmic trading, which now accounts for 60 to 70% of all market volume. When volatility spikes, algorithms are programmed to sell. This means the death spiral will be faster and more violent than anything seen in 1929. Second, the credit contraction. In the aftermath of the 1929 crash, banks stopped lending. They had extended too much credit during the boom, and when asset prices fell, their collateral became worthless. Between 1930 and 1933, 9,000 banks failed. Credit markets froze. Businesses couldn't get working capital. Mortgages couldn't be refinanced. The economy seized up. Today, we face an eerily similar situation. Corporate debt stands at $13.5 trillion. Much of this debt was borrowed at artificially low interest rates between 2010 and 2021. Now, with interest rates higher, companies face a refinancing wall. Between 2024 and 2027, $3.8 trillion in corporate debt comes due. Companies that borrowed at 2% will need to refinance at 6% or higher, if they can get financing at all. When the refinancing crisis hits, it will trigger a wave of corporate defaults. This will cascade into the banking sector. Banks hold trillions in commercial real estate loans, corporate loans, and securities backed by these loans. If default rates spike, bank balance sheets will deteriorate rapidly. The Federal Reserve will attempt to intervene, as it did in 2008. But there's a critical difference. In 2008, the Fed's balance sheet was less than $1 trillion. Today, it's $7.3 trillion. The Fed has less ammunition, and the political will to bail out Wall Street again may not exist. Third, the real economy collapse. This is where the pattern moves from financial markets to Main Street. In 1929, the stock market crash was a Wall Street event. By 1933, unemployment was 25%. Industrial production had fallen by 47%. GDP had contracted by 30%. The crash had metastasized into a depression. The mechanism is straightforward. When asset prices collapse, the wealth effect reverses. Consumers who felt rich because their 401(k)s were growing suddenly feel poor. They cut spending. Businesses, facing lower demand, cut production and lay off workers. Unemployed workers cut spending further. The economy enters a deflationary spiral. But today's economy is more vulnerable than 1929's in a critical way: debt. In 1929, household debt was approximately 20% of GDP. Today, it's 75%. American consumers are more leveraged than at any point in history. When the recession hits, millions will be unable to service their debts. Consumer defaults will spike. Credit card defaults are already rising. Delinquency rates hit 3.1% in Q3 2024, the highest since 2012. This will feed back into the financial system, creating a doom loop. Falling asset prices, credit contraction, recession, defaults, bank failures, more credit contraction, deeper recession. Fourth, the political response. Here's what most analyses of 1929 miss. The crash didn't just destroy wealth. It destroyed the political order. The Republican Party, which had dominated American politics throughout the 1920s, was annihilated in the 1932 election. Franklin Roosevelt won 57% of the popular vote and 472 electoral votes. Democrats won supermajorities in both houses of Congress. Why? Because the public, correctly, perceived that the economic system had been rigged to benefit insiders while exposing ordinary Americans to catastrophic risk. The New Deal that followed, Social Security, banking regulation, progressive taxation, was not a policy preference. It was a political necessity to prevent revolution. Today, we face a similar reckoning. When the collapse comes, there will be demands for accountability. Who got bailed out in 2008? Who profited from the pandemic? Who sold at the top while telling the public to keep buying? The political consequences of the next collapse will be severe. We're already seeing the early stages. Populist movements on both left and right, declining trust in institutions, explicit hostility toward elites. When Stage 7 fully unfolds, the political system will be forced to choose between radical reform and systemic instability. Fifth, the Long Depression. The final element of Stage 7 is duration. The 1929 crash was followed by a decade of economic stagnation. Even after the market bottomed in 1932, it didn't return to its 1929 peak until 1954, 25 years later. An entire generation saw their wealth destroyed and never recovered. Why did it take so long? Because the underlying imbalances, wealth concentration, overcapacity, debt overhang, take years to resolve. You can't just print money and restore balance. The debt has to be defaulted on or inflated away. The overcapacity has to be liquidated. The wealth has to be redistributed, either through policy or through crisis. We are facing the same long adjustment. The debt levels accumulated since 2008 are unprecedented in peacetime history. The wealth concentration is at 1,929 levels. The productive capacity built during the boom is excessive relative to sustainable demand. These imbalances will take a decade or more to resolve. The question is not whether Stage 7 will happen. The pattern has never been broken. The question is, when? Let me be specific about timing, because this is where analysis becomes actionable. Stage 7 doesn't begin with a crash. It begins with a trigger, a specific event that exposes a vulnerability in the system and initiates the liquidation cascade. In 1929, the trigger was the Haytree scandal in London. On September 20th, 1929, British financier Clarence Haytree was arrested for fraud and forgery. His companies collapsed, wiping out millions. This triggered selling in London, which spread to New York. It was a small event. Most Americans had never heard of Haytree, but it revealed that the market was fragile. Within 5 weeks, Black Thursday arrived. What will the trigger be this time? There are several candidates: a sovereign debt crisis. Japan's debt-to-GDP ratio exceeds 260%. China's total debt is over 300% of GDP. If either experiences a debt crisis, it would cascade globally within days. A commercial real estate collapse. South commercial real estate values have fallen 15 to 20% since 2022 as remote work has reduced demand for office space. Banks hold $2.9 trillion in commercial real estate loans. If default rates spike, regional banks will fail, potentially triggering a broader crisis. A derivatives blow-up. The global derivatives market is over $700 trillion notional value. Most of these are hedges that offset each other, except when they don't. If a major counterparty fails, the contagion could be instantaneous. A geopolitical shock. A war in the Middle East that disrupts oil supplies. A conflict over Taiwan that breaks global supply chains. These aren't financial triggers, but they expose financial fragility. The trigger doesn't matter. What matters is that the system is primed. The leverage exists. The imbalances exist. The pattern is in Stage 6. The trigger is simply the match near the gasoline. As to when, Stage 6 in 1929 lasted 2 days. Today, given the speed of algorithmic trading and global interconnectedness, Stage 6 could be even shorter. Or it could last months if central banks successfully coordinate interventions. But here's what we know with certainty. We are closer to Stage 7 now than at any point since 2008. The insider exit is complete. The false rally has occurred. The leverage is in place. The pattern has never failed. Let me end with clarity, not fear. The purpose of understanding this pattern is not to predict the exact day of collapse. It is to recognize that what feels like normal market volatility is actually the late stage of a systemic cycle. The choices you make today, how much leverage you carry, how concentrated your assets are, how much liquidity you maintain, will determine whether you survive Stage 7 or become a casualty of it. In 1929, the insiders who recognized the pattern protected themselves. Joseph Kennedy exited the market in March and used his cash to buy distressed assets in the 1930s, multiplying his wealth. Bernard Baruch, advisor to presidents, sold his stocks in early 1929 and sat on the sidelines in cash. They didn't have better information. They had pattern recognition. The pattern is clear. Post-crisis euphoria leads to credit expansion, which enables wealth concentration, which produces speculative mania, which the insiders exit, followed by a false rally, and then collapse. 7 stages. It happened in 1929. It happened in 2000. It happened in 2008. And it is happening now. The question is not whether you believe the pattern. The pattern doesn't require belief. It requires only that the underlying mechanics of leverage, debt, and human psychology remain constant, which they have for centuries. The question is, what will you do with this knowledge? Because the pattern is entering Stage 7, and Stage 7 has never been kind to those who refuse to see it coming.